Hi, I'm Michael Ruger. I'm the managing partner of Greenbush Financial Group. Because we are a financial planning firm based out of New York, we have a lot of clients that are preparing for retirement, and part of their retirement plan sometimes is to move to a southern state from like New York to Florida, or they're going to do the Snowbird thing where they're going back and forth from Florida to New York. And one of the inevitable questions that comes up is, if I change my state of domicile or state of residency to Florida, will I save a lot in taxes? Because New York's known for high property taxes, high income taxes. And what we find is people have kind of a skewed assumption of how much taxes they're actually going to save by making that move. And for most individuals, the tax difference is actually not that much. And in this video, I'm going to explain the different things that factor into that tax calculation. There are a number of items going to factor into this decision that we're going to go over today. So the first is, a lot of people don't realize that you don't pay New York State income tax on your Social Security benefits, on your pension benefits from a New York State or local government entity. You don't pay New York State tax on the first $20,000 that comes out of IRAs, 401ks. So when people start to factor all this in, they start to realize, well, even if I stayed in New York, I'm not going to pay much state income tax anyway, so does it make sense to make all these adjustments and uproot and go down to Florida? But there's also other things. There's some Medicare insurance implications when you leave New York State. You have to look at the cost of living adjustment between living in New York versus maybe living in Florida. And there's also estate plan considerations that you may have to look into. Let's start off by talking about how Social Security is taxed in retirement. A lot of retirees are very unpleasantly surprised that even though Social Security was a tax that was taken out of your paycheck during your working years, when you get to retirement and start receiving that benefit, you may have to pay federal income tax in your Social Security. So for people that are over certain income thresholds, 85% of your Social Security benefit could be taxed at the federal level. But the good news is in New York State, you do not have to pay state income tax on your Social Security benefits. So if I'm receiving $25,000 and my spouse is receiving $25,000, that's $50,000 worth of income that has no state tax whether I live in New York or in Florida. The second little known fact about New York State income tax is the first $20,000 that you would draw from an IRA, 401k, or other type of employer-sponsored plan after the age of 59 and a half, you do not have to pay New York State income tax on. So if I'm married again, I can take $20,000 out of my IRA. My spouse can take $20,000 out of our IRA, and we don't have to pay any state tax on it. So if you think about that Social Security example we talked about, if we both have $25,000 in Social Security, so that's $50,000, and then we each take $20,000 out of our IRA accounts, that's $90,000 in income that we had to pay no New York State income tax on. Because our firm is based out of Albany, New York, we have a lot of clients that work for New York State, and a lot of state employees have pensions. And the fortunate part about New York State pensions is when you start to receive those, you do not have to pay state income tax on those pension benefits. So if you have two spouses, both of them work for New York State, and they receive $50,000 pension apiece, there is no state income tax due on that pension benefit. It's no secret that in New York State, we have higher property taxes than many other states in the US. So it becomes appealing to say, if I sell my house in New York and buy a similar house in Florida, I might be paying a third of the property taxes I am now. But New York residents also have something called a STARS and an enhanced STARS exemption, which help with some of those property taxes. So for pretty much all homeowners that are residents of New York State, if you're making under $500,000 per year, you can apply for that STARS exemption, which is a regular exemption that reduces some of your school taxes. However, when you turn age 65, it qualifies you potentially for the enhanced STARS, which is a further reduction in your school taxes, but the income threshold is a lot lower. So for regular STARS, it's like $500,000. For the enhanced STARS, it's like $86,000 per year. So as long as you're under that threshold, it could be a meaningful reduction in that property taxes, so that, again, kind of comparing property taxes, New York property taxes to Florida, it could make a difference in that decision. A special note about that income threshold for the enhanced STAR, that even though it is a much lower level, IRA income and annuity income does not count towards that threshold. This property tax situation is also a big thing for the Snowbirds, the ones that go back and forth from New York and Florida and maintain a residence in both states, because they think, well, since I'm a resident in both states, I'll just make Florida the more tax favorable state, my state of domicile. But they don't realize that as soon as you do that, you lose the STARS or enhanced STARS exemption in New York because you have to be a New York resident to claim that exemption. So even though you thought you did yourself a tax favor, your property taxes on that house in New York could be substantially higher than if you were actually still a New York resident. Outside of just the tax analysis, there are some very important considerations to look at with regard to your healthcare coverage in retirement when you're looking at moving between New York and Florida. Now, while New York has higher taxes in general compared to Florida, the one luxury we have is more flexibility with regard to our Medicare insurance coverage. Because when you turn 65, you enroll in Medicare, which provides your health insurance. But since Medicare doesn't provide like all the coverage for you, usually people will enroll in either a Medicare Advantage or a Medicare supplemental plan. Now, unfortunately, most retirees don't understand the difference between the two, but I'll put a link in the description below so you can watch that video. But essentially what happens is if you go into a Medicare Advantage plan, which is sometimes cheaper, you are essentially leaving Medicare. You are no longer covered by Medicare. You are covered entirely by that private insurance company. Where a Medicare supplemental plan, you maintain your Medicare coverage, but the supplemental plan just goes up on top of it. Now, the reason why this is important is we'll see retirees go to the Advantage plan sometimes because they're healthy and they just want to pay less. But if your health needs change, you may want to at some point go back to a supplemental plan. And New York State, you can make that decision on a year-by-year basis. So it gives you some flexibility, and healthcare costs can be a big piece of your overall expenses in retirement versus most other states like Florida. If you go into a Medicare Advantage plan in Florida, you may not have that option that if your healthcare needs change to switch back to a supplemental plan. So in this transition, you really have to evaluate your healthcare options as well when going from New York to Florida. Anytime you're making this move decision, I always say quantify the tax amount that you're saving. Sit with your tax professional and say, if I really make this move from New York to Florida and make that my state of domicile, how much am I really saving? Because at the end of the day, if you're saving $500 or $1,000, you might decide that's not enough to make the move. So I always say go through the exercise and make sure you can quantify that amount. Another non-tax item that is financially related that could impact your decision is a cost of living analysis. So you really list your expenses in New York versus what all those expenses would be in Florida. And it's not uncommon for the northeastern states to be more expensive cost of living than the southern states. And that could also factor into your decision. You should also consider your estate plan and say, depending on what state I am a resident of when I ultimately pass away, does that have an impact on the estate taxes of what my beneficiaries will ultimately receive? Because similar to insurance, that states have different rules, that is also true of estate tax law that you have to factor into your overall plan. All things considered, there are definitely individuals that it will make a lot of sense that when they retire to potentially change their state of residency, but it's gonna largely depend on what your income picture looks like in retirement. And for those that are considering changing their state of domicile, it's not necessarily a walk in the park type process. People think, well, because I got 2 houses and I spend more than half of the year in Florida, I'm good. It's a little bit more complicated than that, so I've included another video specific to that in the description below. If you have any questions, feel free to reach out to us at moneysmartboard.com. Thank you.